Question: is the stock market better or worse if one political party is in office versus another? Well, there's a clear answer, and it's going to change how you look at politics and your money. This show today is about your finances and not an endorsement for either candidate. We only talk about politics and the real impact on your investments. This one will be a shocker you'll want to watch. The information provided today is from research, and it is intended to answer our question of the day. You will be presented with one theory. Mine, please. Nothing provided today is considered financial advice. Please do your own research for any investment. Join me on this journey. Alright, stick with me on the very short bit about the Great Depression. It ties into what I have to say. The Great Depression was a difficult and challenging time for our country, affecting millions of lives. The stock market crashed in 1929, leading to widespread financial turmoil, and it took many years for the economy to recover from this devastating event. Despite this turbulent period, the stock market has shown remarkable resilience over the long term, bouncing back stronger each time. Here, you can clearly see each president at the bottom and how the market responded. So now, from the graph, you can start to see one emerging truth. Overall, Democrat or Republican held presidential office. In reality, growth is minimal for either party. Actually, the difference is only less than 0.4%. This is why it's important to have a long-term perspective when it comes to investing, as short-term fluctuations are often temporary. Since the Great Depression, the market has generally trended upwards, reflecting overall economic growth and progress. This upward trend suggests that over the long term, the stock market tends to increase in value, regardless of which party is in power, providing opportunities for growth and investment. So, let's remember this fact as we move forward and learn a bit more. Now let's take a closer look at how the market has performed under Democratic presidents over the years. Some people believe that Democrats are bad for the stock market, often citing concerns about their regulatory policies. We have recently seen how the SEC has attacked crypto. They argue that these policies hurt businesses, stifle economic growth, and lead to higher taxes and increased government spending. That could be true, but remember, this is only about the market, as you can see those issues no matter what candidate wins. However, when we examine the historical data, we find a different narrative emerging. Since the 1930s, the stock market has generally performed well under Democratic presidents, often exceeding expectations. There have been periods of both growth and decline, but the overall trend has been positive, showing resilience and adaptability. This suggests that the party in power is not the only factor that determines market performance, as many variables come into play. It's important to note that these are just averages, and there is a lot of variation within each party's tenure. Many other factors can influence market performance, such as global events, technological advancements, interest rates, and even investor sentiment. Understanding these complexities can provide a more nuanced view of market dynamics. Now let's turn our attention to Republican presidents. Some people believe that Republicans are better for the stock market. They argue that their policies are more business-friendly and promote economic growth. Again, we need to look at the data. Similar to Democratic presidents, the stock market has also experienced periods of growth and decline under Republican presidents. The overall trend, however, has also been positive. This reinforces the idea that political party alone is not a reliable predictor of market performance. It's crucial to remember that the stock market is a complex system influenced by a multitude of factors. Attributing its performance solely to the political party in power is an oversimplification, and not one based on history and fact. Election years. To invest or not to invest. Election years often make investors nervous. Again, emotions or party lines aside, the question is why. They worry about the uncertainty that comes with a change in leadership. Some investors choose to sit on the sidelines during election years, waiting to see what happens. Truly fearful if the other party would win, what's that mean for me and my investments? However, History shows us that the stock market tends to perform well in the year following a presidential election, regardless of who wins. This suggests that the market anticipates the future and factors in the potential impact of a new administration. It's important to remember that past performance is not indicative of future results. However, the chart showing growth, you simply can't argue with data. While the market has historically performed well after elections, there is no guarantee that this trend will continue. So, the key here is never play the short game. Invest for the long period no matter who wins. The impact of presidential terms on the market. Some people believe that the stock market performs better in a president's second term. They argue that the first term is often marked by uncertainty and policy changes, while the second term is more stable. In the first term, they inherited issues and problems from the other administration. It is the second term that makes the impact. Again, let's look at the numbers, the facts. However, there is no clear evidence to support this claim. The stock market has performed well during both first and second terms of presidents from both parties. Once again, this highlights the fact that other factors are at play. Emotions and frustrations are the central factors. It's important to note that a president's policies can take time to have an impact on the economy and the stock market. Therefore, it's difficult to isolate the effects of a president's term on market performance. Congress and the Senate and its role in stock market returns. While the president gets a lot of attention, it's important to remember that Congress and the Senate also plays a significant role in shaping economic policy. When one party controls both the presidency and Congress, it's easier to pass legislation that could impact the stock market. However, a divided Congress can sometimes lead to gridlock and make it difficult to pass meaningful legislation. This can create uncertainty in the market as investors are unsure about the direction of future policy. Investors should pay attention to the balance of power in Congress, as it can influence the direction of economic policy and potentially impact the stock market. Separating politics from investment decisions. The relationship between politics and the stock market is complex. While the party in power can influence economic policy, it's not the only factor that determines market performance. Global events, interest rates, technological advancements, and investor sentiment all play a role. Trying to time the market based on political cycles is risky and often unsuccessful. Instead of letting your political views dictate your investment decisions, focus on your long-term financial goals. Remember, investing is a marathon, not a sprint. By diversifying your portfolio, staying invested for the long term, and avoiding emotional decisions, you can weather any political storm. The bottom line: focus on your financial goals. The stock and crypto markets can be unpredictable, and political events can add to the uncertainty. But over the long term, the market has consistently trended upwards. Don't let your political views cloud your judgment when it comes to your investments, the money you will need, the generational wealth you will provide. Focus on what you can control: your savings rate, your asset allocation, and your investment strategy. Always use a financial advisor. Never listen to an influencer, like one news channel over another. By staying disciplined and focused on your financial goals, you can achieve financial freedom regardless of who is in the White House. Remember, your financial future is in your hands. Make informed decisions, stay the course, and enjoy the ride. Alright, that was an interesting video to produce. Lots of good information, and I had no clue when I started this research the market would only react 0.01% to 0.04% to any candidate. I have an easy favor. If you are not already subscribed, would you consider subscribing? It's appreciated if you don't mind, and I'll see you in the next video.